Imagine building a retail fortress that literally just prints cash.
Right.
Like you're generating returns on invested capital north of 30%. You've got nearly $2 billion sitting in the bank, zero debt,
Yeah, zero, which is why.
and your revenue's actually growing. And then despite all of that, you just watch the market ruthlessly slash your company's value by 66% in a matter of months.
Just evaporates.
Exactly. Your stock crashes down to around $119, and that premium valuation you enjoyed for, what, over a decade? It just vanishes overnight.
Yeah, it's a brutal reality check.
It really is. So today we are putting Lululemon Athletica, ticker LULU, right on the operating table. Welcome to episode 2 of our special dossier, the Stock Analyst Library, where we are, systematically tearing down every single S&P 500 company.
One by one.
One by one. And we're looking at these massive businesses exclusively through the contrasting lenses of 2 legendary investors. We've got Warren Buffett, the architect of the economic moat, and Peter Lynch, the absolute master of the growth narrative and the corporate turnaround.
And honestly, it is the perfect philosophical collision for this specific company.
Right.
Because, Buffett is just relentless about structural durability. He wants to know if a castle's walls can withstand, like, a decade-long siege.
Yeah.
But Lynch, he's highly pragmatic about momentum, about human behavior. He wants to know if a stalled narrative is, a permanent terminal disease or just a temporary fixable stumble. And Lululemon is currently breaking the models of both of those frameworks.
Which makes it arguably the most fascinating puzzle in the whole consumer discretionary sector right now.
Oh, absolutely. For a decade, Lululemon was the undisputed growth darling of Wall Street. The market happily paid a 10-year median multiple of roughly 40x earnings.
40x.
Because the top-line compounding just seemed inevitable. But today, that multiple has collapsed to around 9x.
From 40 to 9. That's not a dip.
No, that isn't a cyclical dip at all. That is a fundamental re-rating. Wall Street has aggressively reclassified Lululemon from a hyper-growth compounder to, like, a deep value stock.
Value stock. Lululemon. It's crazy to even say out loud.
Exactly. So the central question for anyone looking at this dossier isn't whether Lululemon historically built a good business. We know they did. The central question is whether the brand's structural moat has permanently cracked or if the market has just succumbed to sheer panic and wildly overpunish a temporary operational bottleneck.
Right. And to answer that, we have to look under the hood and establish what kind of economic engine is actually currently running. Because when you look at the raw trailing numbers, they're almost impossible to reconcile with a 66% stock chart collapse.
They really don't make sense on the surface.
No. Let me lay out the baseline for you. Lululemon's return on invested capital, their ROIC, over the last 12 months is hovering between 28 and 32%.
Which is massive.
It's huge. Revenue didn't shrink. It's actually up 5% to $11.1 billion. And they are sitting on that fortress balance sheet we mentioned. $1.8 billion in net cash. Absolutely zero financial debt.
None.
Joel Greenblatt built his entire magic formula hunting for businesses that can hit a 30% ROIC because it proves the underlying machinery is elite at turning capital into more capital.
And that machinery is elite specifically because of their vertical integration.
Explain that, because I think people throw around vertical integration without realizing what it actually means in retail.
Yeah, well, the graveyard of retail is filled with wholesale brands that had to split their pie with middlemen, right? Think about traditional brands selling through Foot Locker and Macy's. Lululemon doesn't play that game. They own the entire life cycle of the garment.
From the factory to the fitting room.
Exactly. They control the manufacturing relationships. They own the 767 global retail locations, and they own the direct-to-consumer e-commerce platform. They own the first-party data. But most importantly, they capture the entirety of the retail margin.
They aren't sharing the profit with anyone.
Right. This is why you see historical gross margins north of 55% and store productivity metrics hitting like $1,400 per square foot.
Wow. $1,400.
Yeah, in the context of a typical suburban mall where a legacy retailer might be thrilled, literally popping champagne to hit $400 a square foot, Lululemon's real estate productivity is just staggering.
But here's the brutal reality check, and it's the exact crack in the armor that triggered that 66% drop. Top-line revenue is up 5%, right? We established that. But their diluted earnings per share plunged from $13.26 last year down to a management-guided $11 for the current year.
That's the pain point.
So we're looking at an engine that is taking in more fuel than ever, $11.1 billion in sales, but it's producing 17% less horsepower at the bottom line. How does a premium, vertically integrated cash machine grow its sales, but watch its profits implode?
Well, we are witnessing a textbook, highly painful execution of negative operating leverage.
Okay, unpack that.
To understand why earnings are collapsing, you have to look at the structural trap of a high fixed cost vertical model. When you control the entire life cycle, it means you own all the overhead.
Right, you're paying for everything.
You're on the hook for the premium commercial leases across those 700 plus locations. You're funding the payroll for 39,000 global employees. You carry the massive supply chain and distribution infrastructure overhead. Now, when you are compounding revenue at 20% a year, that model exhibits beautiful positive operating leverage.
Because the costs are fixed, but the cash coming in is surging.
Exactly. The fixed costs stay relatively flat while the new revenue pours in, meaning an outsized chunk of every new dollar falls straight to the bottom line. It looks like magic.
It's like the sports car analogy, right?
Oh, yeah, the sports car.
Like when you have that high-performance, heavy V8 engine out on an open highway doing 100 miles per hour, the efficiency is a dream. The momentum carries the weight of the car. But the moment you hit dense city traffic, which is exactly what 5% top-line growth is for a company that's used to doing 20%, the fuel efficiency absolutely tanks.
Yeah, you're idling.
You are idling. You're still burning massive amounts of cash just to keep the engine running, but you are barely moving forward. The fixed costs are rising. I mean, you've got rent escalations, wage inflation, and they're rising faster than the sales growth can absorb them.
And for a business whose entire multi-billion-dollar valuation rested on the assumption of expanding profit margins, watching that math run in reverse is terrifying. Wall Street models do not tolerate negative operating leverage gracefully. They just puke the stock.
They really do.
But to figure out if this is, a terminal disease or just a temporary traffic jam, we have to isolate the specific mechanic that is suddenly driving those costs up and crushing the margin.
Which brings us to the absolute spine of this deep dive. The single most important operational insight in our entire stack of source material.
Yeah, this is it.
The antagonist in this story isn't just a broader macroeconomic slowdown. It is the United States border. We have to talk about the sudden, violent asymmetry of import tariffs.
The Q1 numbers tell the story here perfectly. In the first quarter of fiscal 2026, management disclosed that tariffs carved roughly 280 basis points straight out of their product margin.
That's almost 3%.
Exactly. In retail, where survival dictates fighting for fractions of a percent, losing nearly 3% of your margin on the physical product is catastrophic.
It's a bloodbath.
Right. So to understand why this is happening, we have to look at the mechanical reality of how a tariff actually functions in the global apparel supply chain.
Right. Because the political rhetoric around tariffs often obscures the actual accounting reality. A tariff is not a tax paid by the exporting country. Like when Lululemon manufactures a pair of leggings in Vietnam or Cambodia, the Vietnamese government isn't writing a check to Washington.
No, not at all.
The tariff is a tax paid exclusively by the importer of record.
Precisely the mechanic we need to focus on. Lululemon is the importer. So when that shipping container of apparel arrives at the port of Long Beach from Ho Chi Minh City, Lululemon must physically remit that tax to U.S. Customs and Border Protection before those goods can ever enter the domestic supply chain.
They have to clear the border with cash.
Right. And recently, the U.S. enacted sharp tariff hikes on apparel sourced from these specific Asian manufacturing hubs. So overnight, the landed cost of every single garment bound for a U.S. store spiked. And management essentially has 3 levers they can pull, right? And all of them are highly problematic.
Let's walk through the levers. Lever 1, they could just raise prices, right? But they can't really just hike the sticker price on a pair of leggings to, like, $150.
No, U.S. consumer demand in the athleisure category is already softening. Testing pricing elasticity right now would likely crater their sales volume.
Right, you just drive people away. Okay, lever 2. Move the factories.
Which they also cannot do. You can't meaningfully shift their supply chain out of Asia in the near term. The infrastructure, the technical fabric mills, the skilled labor pool required to produce Lululemon's specific, proprietary blends, they simply do not exist at scale in the Western Hemisphere.
It's not like stitching together a basic cotton t-shirt.
No, it's highly technical. Moving a global supply chain like that takes the better part of a decade. It's not a quick fix. So they have to pull the only remaining lever, lever 3. They absorb the tax.
They just eat it.
They eat the cost, And the profit margin takes that massive 280 basis point hit.
But, and this is huge here, is the massive structural secret hiding inside that margin collapse.
Yeah.
This is the asymmetry that completely changes how you evaluate the future of this business.
Right.
Lululemon goods manufactured in Asia and sold in Shanghai or London or Dubai, they never physically cross the U.S. border.
Never. This is the crucial wedge in the narrative. A U.S. import tariff is strictly a geographic penalty. If Lululemon sews a technically complex jacket in Vietnam and ships it directly to a distribution center serving the European Union or the Asia-Pacific market, it never touches U.S. soil.
So there's no U.S. customs agent asking for a check.
Exactly. Zero U.S. tariff is owed. While other regions have their own baseline duties, obviously, this sudden punitive cost spike that is tearing apart Lululemon's consolidated profit and loss statement is uniquely isolated to their American inbound freight.
Let's break down how this geographic split manifests in the actual growth numbers, because it's wild. We are essentially looking at two entirely different realities coexisting inside one ticker symbol.
It's like two different companies.
Right. So the segment under the most severe margin pressure from these tariffs is the Americas. And the Americas segment, which accounts for roughly 74% of their total sales, it's actively shrinking. Comparable sales in the Americas were down about 6% last quarter. The traffic jam is real.
It's very real, but then you look at the international engine, mainland China revenue is up 30%.
50%.
And the rest of world segment, which is Europe, the Middle East, the broader Asia-Pacific region, that's up 13%. So the international business is quietly exploding at double-digit compound rates, and it is entirely immune to the U.S. border shock that's dragging down the blended margin.
Okay, I hear that, but I have to push back on this international narrative. It's easy to look at a 30% growth rate in China and assume the engine will just run forever. But Lululemon built its entire brand DNA around a very specific, almost distinctly North American, Pacific Northwest yoga ethos.
No, Vancouver.
It's exactly. Community-run clubs, grassroots studio ambassadors, coastal wellness culture. Are Chinese consumers actually buying into the Vancouver yoga ethos? Or are they just buying an expensive Western status symbol that will inevitably lose its heat in, like, 12 to 18 months?
It is a highly valid skepticism. When a premium brand expands internationally, the risk of cultural dilution is massive. You see it all the time.
Right.
But what Lululemon has effectively done in China is localize the community model. They aren't just exporting Vancouver, they're heavily recruiting local fitness influencers and regional athletes to build bespoke communities in Tier 1 Chinese cities.
So they're running the same playbook, but with local faces.
Exactly. The product functions as a status symbol, yes, but the grassroots marketing infrastructure that drives repeat purchases, that's actually being replicated quite well. And the sheer size of the addressable middle class in China means that even if it is partially a status play, the runway for store expansion is immense.
Okay, but 30% growth in any major market is going to act as a beacon for every competitor with a balance sheet.
Oh, they're all watching.
Which forces us to apply the Buffett lens.
Yeah.
We have to look at the moat, the durability, and the capital allocation. If the international market is the engine of the future, what is actually stopping a rival from ripping off this exact playbook? Are we looking at a fortress or just a really nice tent?
Well, when we apply Pat Dorsey's framework for economic moats, the vulnerability becomes glaringly obvious. Dorsey categorizes moats into intangible assets, switching costs, network effects, and cost advantages. Lululemon's moat is almost entirely an intangible asset. It is a pure brand moat.
Which is why Morningstar assigns them a narrow moat rather than a wide one.
Correct, a narrow moat. The brand equity is what allows them to charge $118 for a pair of line pants. It's what allows them to sell massive volumes of inventory at full price without resorting to the heavy, margin-destroying discount cycles that plague legacy mall retailers.
Nobody wants to be gap discounting everything 50% off.
Exactly. Their vertical integration supports this. But the vertical integration only works if the consumer actually desires the product. A brand moat is inherently the most perishable competitive advantage in existence.
Because it carries absolutely zero switching costs. I mean, this isn't an enterprise software deployment where migrating to a new vendor takes 2 years and costs millions in retraining.
Right.
It's not even an Apple ecosystem where switching to Android means losing your iMessage groups and your iCloud photos.
God forbid.
Right. The switching cost in apparel is literally zero. A consumer just walks at a Lululemon, walks across the mall concourse, and tries on a different pair of pants. You have to re-earn their loyalty every single season.
Every season. And that reality transitions us perfectly to the ultimate stress test.
Yes, the $10 billion moat test. We do this for every major player in this library. The premise is simple. If we handed a highly confident, ruthless competitor $10 billion in cash and gave them the singular mission of permanently destroying Lululemon's market share, could they pull it off?
And, you know, when we looked at Visa, the answer was a definitive no. $10 billion cannot replicate a globally entrenched two-sided payment network.
Not a chance.
But if we are being intellectually honest about Lululemon, it does not pass this test. It fails.
It fails because we are watching it happen in real time, and the rivals are doing it with a fraction of $10 billion. The challengers are already inside the gates.
They really are.
Look at the aggressive market share captured by brands like Vori and Alo Yoga. They didn't come in at the bottom. They didn't try to undercut Lululemon on price, like selling $30 leggings. They targeted the exact same affluent, aspirational customer at the exact same premium price point.
Let's dissect the mechanics of how Vori and Alo actually achieved that, because their playbooks really highlight Lululemon's specific vulnerabilities. Let's start with Vori.
Yeah, the California brand.
Right. Founded in Southern California, Vori essentially attacked Lululemon's weaker flank, the male consumer. They went after the guy who wanted premium performance fabrics, but actively rejected the overt athletic styling of legacy brands.
They didn't want the giant reflective logos.
Exactly. Vori championed a stealth, wealth, anti-loud branding aesthetic. They focused on hyper-soft, versatile materials that transition seamlessly from a workout to a casual office environment. And by doing that, they captured a massive demographic of men who felt alienated by Lululemon's traditional yoga-centric narrative.
And then Alo Yoga ran a completely different, highly weaponized playbook targeting the female demographic. Lululemon built its empire over 2 decades using grassroots community marketing, finding the best local yoga instructors, making them ambassadors, giving them free gear.
Right, the community approach.
It's authentic, but it's slow. Alo bypassed the local studio entirely and just went straight to Beverly Hills. They leveraged a massive, celebrity-driven, digital-first aesthetic. They seeded product on high-profile influencers across Instagram and TikTok, cultivating this incredibly scarce, highly curated, scene cachet that resonates deeply with Gen Z.
And the contrast there is stark. Lululemon became ubiquitous. There is a sprawling Lululemon storefront in nearly every affluent suburban mall in North America.
They're everywhere.
Everywhere. Ubiquity is fantastic for generating $11 billion in revenue, but it is the natural enemy of exclusivity. Alo Yoga offered the scarcity and the modern brand heat that Lululemon's massive footprint naturally diluted.
So the brand moat successfully defends their premium pricing like they aren't slashing prices to zero to survive, but it is completely porous when it comes to defending market share against nimbler, trend-aligned rivals.
Exactly. The moat keeps the margins from collapsing to zero, but it doesn't stop the bleeding at the edges. And unfortunately for Lululemon, the pressure isn't just coming from fierce rivals on the outside, it's coming from inside the boardroom.
Yeah, we have to pivot to the governance drama because the corporate instability perfectly mirrors the brand crisis.
It really does.
We have to unpack the human element here because the governance timeline over the last 6 to 12 months reads like an HBO script.
It's Succession, but in yoga pants.
Exactly. Let's lay out the history. Back in December 2025, Chip Wilson, the outspoken founder of Lululemon, who still controls roughly 8% of the outstanding stock, he launched a highly public proxy fight. He attempted to rally dissident shareholders to replace the existing board of directors.
Now, Chip Wilson has a long, highly controversial history with the company he founded. But his critique this time wasn't just about a sluggish quarter of sales. It was an existential attack on the DNA of the brand.
Right, it was personal.
Very. He publicly stated that the board had allowed Lululemon to drift from being a visionary trendsetter that defined the global athleisure category into a bloated trend follower chasing fast fashion. And he used the word generic.
Ouch. Calling the premium empire you built generic is the nuclear option.
It is.
He essentially validated the exact critique that Alo and Vori were using to steal market share. He handed them the marketing copy.
Basically, yeah.
And shortly after that proxy fight went public, the longtime CEO, Calvin McDonald, stepped down in January 2026. The company was thrown into a leadership vacuum, run by interim co-CEOs, while the core North American market was simultaneously shrinking and getting hammered by that tariff shock we talked about.
And nature abhors a vacuum, right?
Yeah.
Especially in the capital markets. It was rapidly reported that Elliott Management, which is arguably the most feared activist hedge fund globally, had accumulated a massive stake in Lululemon, estimated at over $1 billion.
$1 billion.
Yeah. And Elliott doesn't take billion-dollar positions to be a passive observer. They arrive with a mandate to force structural changes, cut bloat, and engineer liquidity events or massive buybacks.
And the capstone to this boardroom chaos, the company finally named a permanent CEO, Heidi O'Neill, who officially takes the helm this September. She is a highly respected former senior executive at Nike,
Right.
and the market's reaction was brutal. The stock dropped nearly 20% in the weeks following the announcement.
Well, the market reaction reveals a deep philosophical anxiety. Investors are questioning whether a massive, corporate, wholesale-oriented Nike playbook can possibly be transplanted onto a grassroots, vertically integrated, community-driven yoga brand.
Because Lululemon's entire early cultural ethos was built on specifically not being Nike.
Exactly. They didn't do massive wholesale. They didn't do multi-million-dollar celebrity athlete endorsements. Bringing in a Nike veteran signals a fundamental shift in corporate strategy that just terrifies purists.
So how do we process this sheer concentration of instability? You've got a founder dropping tactical nukes on his own board, a CEO vacuum, a billion-dollar activist circling the waters, a contested new hire, and the supply chain tariff crisis all detonating simultaneously.
This is where we have to deploy Howard Marks and his framework of second-level thinking.
Okay, let's bring in Marx.
First-level thinking is reactionary and obvious, right? The founder says the brand is dying, the leadership is a revolving door, the margins are under siege by the U.S. government, and an activist is trying to strip the copper wire out of the walls. The logical first-level response is to sell immediately. Run away.
Just dump the stock.
Mm-hmm.
But second-level thinking demands that we ask, is the pessimism actually overdone? Is this catastrophic narrative already entirely priced into that 9x PE multiple?
Exactly. Let's look at the actual behavior of the players involved. Chip Wilson is a billionaire. Elliott Management deploys tens of billions of dollars. When a founder initiates a costly proxy fight and a top-tier activist commits $1 billion of capital to a collapsing stock, they aren't betting that the company is going to zero.
No, you do not fight a bloody war for control of a sinking ship.
Exactly. You fight for control of a ship that you believe is structurally sound but temporarily off course.
They're looking at the exact same $1.8 billion in cash and 30% ROIC that we are, and they are betting the business is highly fixable.
Yes. Their capital allocation implies they believe the brand is merely bruised, not broken. They believe that a 9x multiple on an engine this efficient is a massive mispricing, provided the operational bloat can be excised.
And the proxy fight actually settled quietly in May, right? With Wilson securing 2 board seats, and one of those went to a former executive from the rival footwear brand On.
Which is huge!
Yeah, that injects fresh, modern, high-growth brand expertise straight into the boardroom, just as Heidi O'Neill arrives. It's a quiet catalyst for a turnaround.
Which means we need to pull out the Lynch lens. We've used Buffett to dissect the moat and the durability. Now we need Peter Lynch to analyze the story, the valuation, and the growth runway.
So if the brand is fixable, how do we value a stock going through this kind of high-stakes metamorphosis?
Well, Lynch categorized stocks into specific stories, and Lululemon is currently experiencing a painful identity crisis between categories. For 14 straight years, it was a textbook fast grower, compounding revenue at 20 to 30% annually. The market rewarded it with a 40x multiple.
But that era of hypergrowth is definitively over.
It's over. Today, it is trapped in a transitional limbo. It is caught between settling into being a stalwart, large, highly profitable, slow-growing cash cow, and being a classic turnaround play.
And Lynch famously loved turnarounds. In his seminal book, One Up on Wall Street, he dedicated significant ink to the Chrysler turnaround of the early 1980s.
A classic.
Right. Wall Street had completely left Chrysler for dead, assuming the structural issues in American auto manufacturing were just fatal. Lynch looked at the underlying assets, bought in, and wrote it to one of the biggest multi-bagger returns of his career.
The crucial nuance of Lynch's Chrysler thesis wasn't just blindly buying a distressed asset. The lesson was that a fundamentally sound business facing severe, highly publicized trouble can represent a once-in-a-decade asymmetric investment opportunity, provided the trouble is temporary and not terminal.
Now, obviously, Lululemon is not Chrysler. Chrysler was staring down the barrel of actual bankruptcy and required federal intervention. Lululemon is sitting on a mountain of cash and generating huge free cash flow. But the shape of the psychological decision facing the investor is identical.
The psychological shape is identical, yes, but the mathematical tools we normally use to evaluate it are currently failing us.
Ah, they break.
Lynch's favorite valuation heuristic was the PEG ratio, the price-to-earnings multiple divided by the annualized earnings growth rate. The rule of thumb is that a PEG of 1.0 indicates fair value. A PEG of 0.5 is a screaming bargain.
So I pulled the data to run the PEG ratio for Lululemon ahead of this deep dive, and the formula literally breaks.
It just errors out.
Explain why the math falls apart here for people who might be trying to run it at home.
It breaks because the denominator is deeply negative. The PEG ratio requires a positive forward growth rate to function. But Lululemon's near-term earnings are actively falling. We said earlier, management guided EPS to drop from $13.26 to roughly $11.
Right, which is a negative growth rate of roughly 17%.
Right. Mathematically, you cannot divide a 9x multiple by a negative 17% growth rate and extract a meaningful valuation metric. The formula produces a nonsense output.
You literally cannot divide by a negative in this context. And that is a massive flashing warning sign for anyone using rudimentary stock screeners.
Oh, yeah. It is the defining hallmark of a value trap. Lynch repeatedly warned investors against buying a stalled fast grower solely because the PE ratio suddenly looks cheap compared to its historical average. A falling PE multiple attached to rapidly falling earnings is a knife-catching exercise.
Right up until the exact moment the earnings floor stabilizes.
Exactly.
So if the spreadsheet math is physically broken and the PEG ratio is useless, how is a listener supposed to evaluate the turnaround?
You have to revert to Lynch's most primal methodology, a concept he actually inherited from Philip Fisher. Scuttlebutt.
Scuttlebutt.
Yeah. When the spreadsheets fail, you have to invest in what you know and observe the physical reality of the business in the wild.
So get away from the Bloomberg terminal and go to the mall.
Precisely. You walk into an upscale shopping center, you stand in the concourse and you observe the Lululemon storefront, and then you watch the Alo Yoga store. You don't need a finance degree to count the shopping bags leaving the store.
No, you just need eyes.
Right. You look at the demographic of the foot traffic. Is the Lululemon product assortment looking stale and heavily discounted on the clearance racks? Or does it still command full price attention? Are the fitting rooms packed? Scuttlebutt allows an observant investor to detect the return of brand heat quarters before it ever crystallizes on a 10Q filing. You are looking for physical evidence that the bleeding has stopped.
Okay, scuttlebutt is essential, I agree. But we still need a robust quantitative framework to ground our assumptions. We can't just count shopping bags and guess at the fair value.
No, we need numbers.
Quick break. This show is built on the fundamental research of Yehonatan, our lead analyst and founder. Want his tools? Click the Substack link below to get 3 free resources for this company. The full deep dive PDF, an interactive valuation model to test your own growth and discount rate scenarios, and a 20-year financial spreadsheet, all completely free. Now back to the numbers.
We will start with the bull scenario.
The happy path.
Right. The narrative here aligns with the Elliott management thesis. The brand stumbled, it got bloated, but the core DNA remains elite. Heidi O'Neill successfully implements structural efficiencies, the proxy fight forces necessary modernization, and the North American market stabilizes and reaccelerates. Meanwhile, that tariff-immune international engine continues compounding at 20+%.
Okay, so what are the inputs for that?
To model this, you would input roughly a +9% blended annualized revenue growth rate over the next 5 years and assume the company recovers its historical 14% free cash flow margin.
That is the optimistic Peter Lynch turnaround thesis playing out perfectly. What is the base scenario?
The base scenario assumes the hypergrowth era is permanently dead, and Lululemon matures into a classic stalwart. The international segment carries the entirety of the growth burden, while the core North American market essentially flatlines.
So it's stopped shrinking, but it never regains its former glory.
Exactly. Margins settle structurally lower than their historical peaks because the company has to permanently absorb a portion of the supply chain tariffs and spend more on marketing to fend off worry and Alo.
They just have to fight harder for every dollar.
Right. The baseline assumptions here would be roughly +4% top-line revenue growth and a normalized free cash flow margin of around 11%.
Okay, and then we have the bear scenario, the nightmare.
The bear scenario models structural compounding decay. The macroeconomic environment for the athleisure category permanently cools. The brand drifts further into the generic territory Chip Wilson warned about, entirely losing its premium pricing power.
So they become Gap.
Basically. Competitors systematically bleed their market share, the North American footprint becomes a massive real estate liability, and the margin profile permanently compresses. To model this grim reality, you would input negative 2% annualized revenue growth and model the free cash flow margin deteriorating down to 8.5%.
Having spent hours running different permutations through our model before we started recording, I have a stark observation.
Yeah.
The current $119 stock price suggests that Mr. Market, in all his infinite wisdom, is currently pricing in a reality that sits dangerously close to that bear scenario.
Which brings us full circle to Howard Marks and the margin of safety. The market has priced in an overwhelming consensus of bad news. At a 9x multiple, the stock is being priced as a melting ice cube.
Right.
If you believe the bear scenario is the inescapable reality, then the stock is fairly priced and it remains a value trap. But if you're scuttlebutt and your research suggests that the base or bull scenarios are even marginally probable, the risk-to-reward ratio suddenly becomes highly asymmetric.
You are no longer paying for perfection. At 40x earnings, any slight miss is catastrophic. At 9x earnings, backed by $1.8 billion in cash and a 30% ROIC, you're paying for a severe stumble. The question is just whether they can stand back up.
That's exactly the setup.
We have covered a massive amount of ground in this dossier. The mechanics of negative operating leverage, the violent asymmetry of the U.S. border tariffs, the fragile nature of a brand-only moat, the $10 billion stress test against Vori and Alo.
And that high-stakes boardroom chess match.
Right. The disgruntled founder, the billion-dollar activist, the contested new CEO. We need to leave you with the ultimate unanswered question of this deep dive. Is Lululemon a former fast grower that is permanently degraded into a slow grower?
Right. Is it cheap for a reason?
Exactly. Is it cheap for a very good reason, because the golden era of the yoga pant is simply behind it? Or is this a fundamentally elite company caught in a temporary 1 to 2 year stumble, violently squeezed by a sudden tariff shock and a cooling macroeconomic cycle that will eventually resume compounding over the long term? Is this the classic Peter Lynch-style turnaround opportunity of the decade?
And as you ponder that over the coming quarters, here is the deciding sub-question that will ultimately dictate the answer. Which engine will command the next 5 years of this company's life cycle? Will it be defined by the shrinking, tariff-squeezed, highly mature America's market? Or will the narrative be hijacked by the fast-growing, tariff-immune, highly profitable international business?
If you enjoyed today's analysis, make sure to follow the show on your favorite podcast app so you never miss an episode. As a reminder, this podcast is for informational and educational purposes only and does not provide financial, investment, or legal advice. Investing involves risk, and you should always do your own fundamental research and consult a qualified professional before making any financial decisions. Thanks for listening, and we'll see you next time.